Dear viewers, welcome to this episode of Your Life, Your Money. For the investors who have seen lots of profits in the last 4 years, the current situation does not look to be a happy one. At the time of recording this video, markets are well below 77,000 on the Sensex, well below 23,300 on the Nifty. Both have breached a critical level which has not breached in the last few months. It only indicates there is more downside which is coming in. It does not feel very good when you look at your portfolios. Is it something you should be very concerned about? Is there something that you should be doing the remedial measures at this point of time? In this episode, I'm going to talk about all these pain points and how you can come out of these pain points. Stay till the end of the video and get the proper guidance for you to go through this difficult period. This is NRI Money Clinic for you, and I am Dr. Chandrakant Bhatt, your financial guide for a happy living.
NRI Money Clinic. No hype, just the right advice.
At the time of recording, which is on 13th of January, Monday, what I saw was the markets breaching critical levels. In the last year, we saw Sensex making a peak at 86,000, very close to it, almost it touched it. And the Nifty crossed 26,000 on the upside, somewhere around 26,300 or so. And where are we right now? The Sensex is well below 77,000 and Nifty is below 23,300. They have breached the critical downside marks. What does it indicate? It indicates there is one more leg minimum which is going to go down from here onwards. It's not something which will end in 1 or 2 days. It could take a couple of months before the markets might stabilize. When the markets give up after 4 years of long run, it is not going to be a short blip. It is something which is materially changing there. You have seen during the last year how the FIIs have sold a great amount. It's not because there is something wrong which has happened in the Indian market. It's just that they have made a lot of money in Indian market. So they wanted to book out and move money elsewhere where they found the profits all over again. Now, how do we see the situation here? As an investor, what is that we have to be mindful of? Are there pain points? Are there points of risk? Is there anything remedial measures you can do at this point of time? Let's look at all this in this video. Let's look at what has really changed. You see the indices are moving downwards. What has changed? Has the companies changed? Has the business environment changed? Has the profitability come down? Is there a regime change? What exactly is changing? What has really changed is the willingness of the buyer to pay a price for the stock or a fund or any of the assets that are listed over there. 1 year before, everybody was very hopeful that the prices will continue to rise higher. Therefore, they were paying a price for that stock and the mutual fund. But now it has come to a stage wherein which the willingness of the buyer has come down. Now people are not prepared to pay the price. What changed is the perception. 1 year before, you thought that the prices are going to go up. Now the perception is telling tomorrow the prices may fall down further on. So the perception has changed. Nothing on the ground has really changed. The companies which have made their plans to increase the revenue growth, add more products, take a move to the newer territories, add to the product lines, nothing has changed. It's all the same. It has remained same. What has changed is the perception of the people. From a perception of euphoria, it has given rise to a perception of a bleak future. That's what has changed. If you're an investor, when you see your portfolio which is falling day after day, what does it really mean for you? The stocks that you are owning in those portfolios or the mutual funds what you are owning in those portfolios, the underlying businesses, the banks, the factories, the services industry, everything remains the same. The only thing which has changed is the valuation which is attached to that. That's it. What does it mean for you? Have you really lost money? Because the markets have fallen, the headline newspapers, television channels, everybody keeps screaming, telling that the investors lost lakhs of rupees of money. Is it the true thing? Have you really lost money? It gives you a feeling when you see a portfolio that you have lost money when you compare it for something which was there 1 year before. But in reality, you have neither lost money nor you have gained money. Let's imagine that you were an investor from last 20 years. 20 years before, the value of Sensex was somewhere around 4,000 to 5,000 on the Sensex. Even after the correction today, the market is at about 77 or slightly lower than 77,000 on the Sensex. So compared to the day of your investment, today you are still at up, you have nothing to be worried about. Of course, nobody feels happy that the valuations have come down. For somebody who invested last year, that was at 82, 83, 86,000 on the Sensex. Now the valuation has come down to 77. Obviously, your invested amount looks higher and the current valuation looks lower. But have you really lost money? The answer to that is no. You have not lost money. The meaning of a portfolio valuation is it only tells you if you sell your stocks or the mutual funds today, this is the amount you are likely to get when you sell it today. Let's assume that you have put a lakh of rupee somewhere in June last year and today you see the valuation at, let's say, 90,000 rupees. It gives you a feeling that I have lost 10,000 rupees. You have not lost 10,000 rupees. The meaning of this valuation is your invested value 1 lakh. If you try to sell out today, you may lose 10,000. That's the meaning of it. Don't be under the impression that you have lost 10,000 rupees. If you have no intention to sell it today and you have invested this a lakh of rupee with an intention that you are trying to do with something out of the gains that you make 10 years later, whether it quotes 90,000, whether it's quote 80,000, whether it quotes 1,20,000, it just doesn't matter. So the portfolio valuation only means that if I sell it today, this is the money that I am going to get. It has no other meaning. Don't get carried away by what you read in the newspapers or what you see on the television channels. The sensationalization of markets falling does not affect you in real terms. But if you have invested this money 1 lakh last year and you wanted this money to pay for your daughter's college fee in next 2 to 3 months, then make no mistake, you have to be concerned about it. So stock markets are not for somebody who wants to invest for 1 year, 2 years. On my channel, I keep telling all the time, you come to the stock market only when you want to stay invested for more than 10 years. That's an ideal period. The minimum time period that you should have in stock market is minimum 5 to 7 years period of time. 5 years of market remaining down or remaining static is perfectly normal in the stock market and you don't have to worry about. So if your life goal is far away, if your time horizon is far away and you have no utility for this money today, you are under no compulsion to cash out and book that losses, you have nothing to be worried about because your portfolios are looking down at this point of time. In fact, if your intention is to make a lot of money from the stock market, a downtick on the stock market is actually a good news. It is not a bad news. Why it's a good news? It's a good news because you are an investor, you are a buyer, you are not a seller. It's a bad news for a seller. You have no intention to sell right now. You are a buyer, you are putting your money through an SIP account, you have got that bonuses, you have got some spare extra cash which you want to buy. Which is better for you? Buying at a low price or buying at a higher price? So buying at a lower price is a better thing for you. So don't put off your purchases because you see red in your portfolio. Rather, the right thing for you to do is to find courage and make best use of these market conditions and keep buying more and more. Thereby, instead of going with the current, you should swim against the current. It's a contrarian bet. Markets are telling they are falling. But what is that you should do? You should do the reverse of it. The investor and the traders have to follow two different strategies. And they can't survive with the same strategy. A trader is the one who has to go with the crowd. If the crowd feels that the market is going to go up, then you should bet with the crowd. If markets are going to fall, if the crowd thinks like that, then you should think that the prices will fall, then you do a short selling and then buy at a later date. That's for a trader. But for a long-term investor, it is always the reverse of it. If the markets are thinking that the markets are going to go up, then you should slow down. If it is an early bull market, yes, being with the crowd, it's still helpful. But we had seen a 4 years of massive bull market. So bull markets have matured. They have moved far away from the average prices, which are historical in nature. So it's a bull market which has matured. So it is going down. So the time now is to take a contrarian bet. So the market is thinking it is going to go down. But for you to make money, you have to be a buyer today. Buy when there is fear on the street. So don't get perturbed by what you see in the your portfolio valuation at this point of time. I told you that you should not be worried about the portfolios looking red, the markets coming down. And I told you should be a buyer at this point of time. Does it mean to say everybody who watches my program should not be worried? I don't dare say that. There could be a set of people who should definitely be worried about this falling market. And who are these people who should be worried about? The persons who should be worried about this falling market are the ones, primarily the do-it-yourself investors. You could have come into the market in the last 3-4 years. You have been a beneficiaries of the times. You came into the markets, you had some money in your pocket. It's a zamana of fintech companies. You are lured into buying anything and everything. You got carried away by the momentum. You buy something today, you see the prices increasing tomorrow, and because of which you started increasing your exposure to the stock market. And there are those people who didn't have the money, rather made an attempt to take loan, invest the money. You made your own back of the envelope calculation. I pay 8% for the loan. I'll make 14% from the stock market. The small caps will give me 35%. It makes absolute sense for me to borrow and put into the stock market. Please sit up and make note. These calculations will not work in the stock market. If you are somebody who has borrowed money from the stock market, then I don't dare say you sit there. Probably it's better that you take cues from the market and square off your position and learn a lesson out of this. The other set of people who should be worried about is market is all about two things. One is price. The price which is being quoted, the price at which you buy, the price at which you sell. And the other thing is value. Value is intrinsic to a stock or a mutual fund. It has a particular value. Let's say the value is 100. The price could be 120 or a price could be 80. When the price moves away sharply from the intrinsic value, make no mistake, it will come back towards that value all over again. If you have purchased something which had a price but it did not have a value, any amount of you sitting there and waiting for the prices to come back to the previous level, my dear friends, will not happen. So you should learn the art of finding what is the value of the stock. If you have not done, and if you have gotten carried away only with the momentum, and you purchased at a price and now you are disturbed with the price, the right thing for you to check is what is the true value of that particular asset that you are holding today. If it has a value and the price is quoting below the value, you have nothing to worry about. But if the asset that you have purchased, the stock that you have purchased has no value, has minimalistic value, but was quoting an astronomical price, then that price will not come back. Study the different bull markets which have happened in India, 2000 to 2003, dot-com burst, then 2004 to 2008. Study each and every bull market. So there are countless stories that you get to learn from. So if you have got something which has no value but was quoting a price, then it's time that you book the losses and learn a lesson from that. Likewise, there are people who get carried away by the fashion of the day. Something is moving today. Small caps are moving, mid caps are moving, particular set of stocks are moving, power could be moving, defense could be moving, anything could be, or there could be a simple thematic thing. These are the ones which will again come back and hit you very badly. I cannot say whether they will recover or not. They might recover. They may take 10 years, 15 years to recover depending on how essential it is in the industry, how strong the businesses are, how good the corporate governance is. Based on that, they may come back. But the chances are that a bull market will always lift every boat. Most of the time, the gullible investors will fall prey to the momentum. They buy something which is crap and it will not see a second bull market at all. So it's time that if you're worried, do your own research or take the help of somebody and see what you're holding is worth it, whether it has a value, whether there is a scope for it to come back and you recover your money. And such people have to be deeply, deeply worried about. If you're working with seasoned financial planners and you have worked under their guidance and they are handholding you and making sure that you are investing in the right places, then the downtick what you see in the stock market is something which you should never be worried about. So what is the right thing for you to do at this point of time? Number one, do not panic. If you are working with a financial advisor already, pick up the phone, talk to them. Most financial advisors at this point of time will do programs for an outreach to their clients to explain them what exactly is happening in the marketplace. Should they be worried? What changes they have to make? All these things, generally responsible financial planners will do that. Those of you, if any of you are working with us who are watching this video, you have absolutely nothing to worry about. Your portfolios are perfectly fine. We always stay in the center of the thing. We always go with the value. We are very mindful of the price that we are going to pay for it. You have absolutely nothing to worry about. If you are somebody who is a do-it-yourself investor, this is the time you take the opinion of a financial planner. Talk to somebody, show them what you have, take their opinion. Whether you follow them or not is secondary in nature, but take a second opinion. You might be thinking that what you are doing is right, but it need not be the thing. Take a second opinion. If you get an opinion that what you are holding is of good quality, there is a value in it, this is a sustainable business over a period of time, it is going to make money, you don't have to worry about. But don't leave under an impression that what you thought is the right thing and nothing can change from this. Many a times what happens is that you live under this belief and those stocks will never see one another bull run during their lifetime. That's a distinct possibility. Those of you who are investing through the SIPs, systematic investment plans, if you are in good quality large cap funds, if you are in a diversified mutual fund portfolio, if you are in funds which are centerline, I would say don't go to the extreme thematic sides or micro funds, small cap funds and other things. You have nothing to worry about. Don't stop your SIPs. Please do continue with them. Those of you who are invested in a unit linked insurance plan, again, do not worry. Don't change your funds from equity to debt because markets have fallen. That's a wrong thing to do. So this is the time, let you continue to buy those equity funds. Don't change it to a debt fund and make a double mistake. So ULIPs are fine, mutual funds are fine, stocks are fine, ETFs are fine, index funds are fine, anything which is linked to the stock markets are fine. Continue to buy as you originally planned. Just because markets have fallen, don't change anything there. For those of you who feel now that it's not my cup of tea, I want to invest but I want a professional guidance, you can make best use of services provided by NRI Money Clinic. You can reach out to us through a WhatsApp message. Our number is shown in the description box below. Send us an exploratory message and our team of experts are always ready to help you in case if you wish to invest through our distribution network. I would like to add a warning for a few of people who are invested in the stock market. It is not that I'm threatening you, but I'm giving you an alarm out here. All those people who campaigned for SWP mode of payouts to create an income, sustainable income, this is a testing time for you. You came and put a large amount of money thinking that the stock markets will give you 10%, 12%, 14% on a sustainable basis. One of my popular videos which I did just a few weeks before talked about sequence of return risk. I'll request my editor to show that thumbnail here. If you have still not watched that video, I suggest and I insist you please watch that video, and it has the history of literally 30-40 years of Indian stock market, why SWP is not a working solution, and it will be tested now when the bull markets are giving up and creating that red lines in your portfolio. So SWP will not work. If you are somebody who is dependent on SWP to create an income, this is a time you sit right now and think whether it is really working for you or not, and hold those people who have said that SWP is a working model for them. You must hold them responsible. People cannot play with somebody else's life this way by telling that SWP is a sustainable answer to create an income. Let's also understand what happens when the bull markets give up. I have done multiple videos in the past. See, when a bull market gives up, several things will happen. It is a tectonic shift which is happening. A bull market grows with continued belief in the market system by the participant. The retail outpowers the institutions, and that's why even when the institutions are selling, the retail still overpowers them and keeps buying that. But retail does not have so much of a cash. At some point of time, they'll run out of the cash. The first thing which happens is the fashion of the day changes. Every bull market has a fashion of its own. There is some sector which is growing, there is some particular stocks are growing, and when the bull markets give up, this fashion changes. And a new fashion emerges after some time. When the bull markets give up and you get into a bear market will go down and sit there at the bottom, wait for the next opportunity, which is not going to be 1 month, 2 months. It is going to be a prolonged period. See, today the markets are below 77,000 on the Sensex. The previous peak was 86,000. So the 86,000 peak will not be taken out in a hurry. Markets will take time. It will settle down. It will remain there. It will languish. And then the new bull market will start. That bull market takes time. It will not go that quickly. The leadership in the new bull market will not be same. Let's imagine that this bull market is led by the PSU. Make no mistake, the next bull market will not be led by the PSU. I'm just telling an example. Don't hold me responsible. Don't base your purchases on what I said. I'm just trying to give you an example. Every bull market, when it gives up, and a new bull market, whenever it emerges in the future, the leadership changes, the fashion changes. So don't bet on the same fashion of this bull market thinking that it will lead the next bull market. That is not going to happen. Sectors will rotate. In this bull market, you saw certain funds are the ones which are leading. There are certain funds which are lagging. What happens when the bull market gives up and a new bear market and then the bull market starts is the sectors will rotate. In one bull market, it could be the infrastructure. In one bull market, it could be the banking. In another bull market, it could be the IT. The sectors will rotate. What is languishing today, its time has come when the new bull market has come. The intelligence lies in betting on the contra and making sure that you go and sit on the correct sectors or the correct funds ready for when the next bull market is about to get started. That is where the beauty of the advisors will come in. This bear market is going to prove why it makes sense to work with the financial advisors. They make a difference. See, there are everywhere the musicians. They play different instrument, but there are very few maestros. Why? Those maestros are the ones who are able to take that extra note, and that's why they are called the maestros. The best of the planners are those who are able to identify those contra calls, who are able to convince their customers, and who are able to be there ahead of time. So working with a financial planner will be proving profitable for you going forward. I'm not telling that you give up your do it yourself. It's your right. You can do what you want to do. But all that I'm trying to tell you is experience has its virtue. So dear viewers, hope the video that I've done today helped you to understand who should be worried, who should not be worried, what are the changes you need to be doing in your approach to your investment. If it did give you all these points to ponder, please do give me a thumbs up. Do not forget to share these videos with your near and dear ones, friends and relatives, and on all the WhatsApp groups on which you are connected with. Thank you very much for watching this episode on NRI Money Clinic. I shall be back with you with yet another thought on your life, your money next Friday.
Press the bell icon for more details and subscribe our channel.